Good morning. Hi there. Good morning and welcome to the trade setup right here on BloombergQuint Live. Lots of news flow. Yeah, we'll try and rush through some of these in order to kind of capture everything in about that 10-minute time that I usually like to talk about. So first, what's happening? What should you watch out for? The world markets were okay. So you have to start off with that the world markets look pretty benign in trade yesterday, particularly the Nasdaq, which actually inched up quite strongly in trade yesterday on account of falling yields. Now, remember yesterday we spoke about how the markets are, and not that it's rocket science, but I'm just saying that how the markets are likely to track the yields in the absence of any other major global event. And yields came off a little bit, arguably on account of the Turkish development, because of which I think the US yields just came off and the US bond strengthened a bit. So Nasdaq went up pretty strongly in trade yesterday. The other bit is that while the markets world over might be doing what they're doing, we still to see the earnings catch up happening. There's this wonderful chart on the Bloomberg terminal which speaks about how the stock rally has vastly outpaced the recovery in earnings expectations. Now, you would argue that this would mean that the markets could fall, or one could argue that way. The other way to look at this is that now that earnings will start playing catch up, the sentiment might well stay positive. Of course, for the earnings to play a catch up, we need no further large lockdowns and supply chain disruptions due to coronavirus, which seems to be in a second wave or third wave, depending on which geography you are in. So hopefully that doesn't happen. But largely the expectations are that now that earnings will play catch up, the sentiment should stay okay. The stocks have done their bit. Now it's for the corporates, underlying corporates to do their bit. Having said that, for the day today, because of the US markets looking benign, I think the early risers in Asia were all looking, well, marginally positive to mixed bag. You would actually now look at the screen and you would see that you're looking a complete mixed bag. Nikkei is up, but Nikkei was down about 2% in trade yesterday, remember. Hang Seng and CSI slightly lower, ASX marginally in the green, Kospi marginally in the red. So it's all over the place, you have to admit. And then let's get the SGX Nifty up on the screen, which had a dull day yesterday, yes, but the broader markets did really well. And therefore, even if the markets were to be flattish or marginally in the positive, you might well see the broader markets do well. Now, just before we get to markets, the other big piece of news, and this seems to be an overhang which the market doesn't seem to be pricing in right now, because the trade war between US and China was supposed to be an overhang when there was Donald Trump in the hot seat. With Joe Biden coming in, people believe that it'll ease off. But look at what's happened. I mean, it's happening. There's, of course, the Quad formation, which is US, Japan, Australia, and India out there are trying to see how they can best combat China's aggressive moves. Now, what's happened overnight is also that the US, UK, EU, and Canada have imposed sanctions against China over alleged human rights abuses of the Uyghurs in Xinjiang province, which of course drew an immediate reaction from Beijing as well. But the point that I'm trying to make is that this is far from over. And usually the biggest risk to the market come from things which are not quite at the forefront. Could this be it? Remains to be seen. So what's the trade setup like because of all of these factors? Now, I would presume that yesterday's session was a reiteration of the defensive trade ongoing currently. The bent of the market is clearly towards defensives, because even in trade yesterday, what you saw that the defensive stocks, IT, FMCG did well, the others not quite. But you had a bit of a broader market strength in trade yesterday, which reflects select contra trades at lower levels. Remember yesterday we was talking about how the deck was getting set up for select contra trades to come up. We're starting to see that happen. And something tells me, just looking at the screen, that in the run up to the expiry, you might well have underperforming spaces starting to do well and give a bit of a trading leg up. So real estate firmly out there, lost 5% yesterday, lost 5% in the whole of last week. Yesterday, you saw the first signs of quality real estate starting to inch up in Godrej Properties. You might well see some of the other real estate stocks in the next couple of days showing a bit of a bounce. So if you were to ask me what is that sector that one should watch out for, I would say real estate should be it for the next couple of trading sessions. Let's wait and watch. So that's the trade setup. Flows were actually, FIs sold about 786 crores, and not unexpected, because banking was just so weak in trade yesterday. It was a telltale sign, and we were talking about that in the market wrap, that the flows should be negative, just looking at the banking stocks in trade yesterday. So what should one watch out for in the session today? first, before stocks to watch, I mean, just keep in mind that the Supreme Court decision on loan moratorium case is expected today, and therefore one should watch out for the ruling on the batch of petitions seeking to extend the loan moratorium period. Let's wait and watch what the decision is and what the final nuances of the decision are. But I think that is something that all of us should be keeping an eye out for. It could impact financials, though I really believe an adverse ruling against financials is very, very unlikely. Stocks to watch out for at 9:15 because the Supreme Court decision will come in later on in the day when the markets have started. But the stocks that I would watch out for, and Maruti's decision has a couple of factors. One, of course, what they've decided to do, and this is as per the company release, is they're going to increase the prices across models from April 1st, owing to the rise in input costs. No, first let's stick to Maruti. The cost of the company's vehicles got impacted adversely due to the increase in various kind of input costs. And remember, this is after Maruti already took a price hike, I think in early Jan. So two things to keep in mind. One, the fact that Maruti is confident enough that the price hikes will probably not impact demand. Or two, that Maruti is in a state of compulsion wherein they can't let such a steep hike in input cost impact their margins so adversely. So it'll be interesting to see how the margin picture is like for some of the auto OEMs in the Jan to March quarter, because yes, let's stick to that, because that is essentially the key thing for Maruti. Some of the price hikes could be to the tune of 5,000 to 30,000 rupees per vehicle. So let's wait and watch what happens on this one. Then let's get to Varrock Engineering. They've launched a QIP to raise about 700 crores. The SEBI floor price is at 395 rupees per share. The company is looking to sell up to 13.35% via QIP. So maybe a slight discount, but if indeed the QIP gets gobbled up very, very easily, this was launched last evening, then you might well see a positive reaction on Varrock. So it depends on how well the QIP is recepted or being received is what will determine what the stock does in the session today. So do watch out for Varrock. And watch out for RIL. I think agencies are saying that Aramco is still in discussion with Reliance over a partnership. This should augur positively for Reliance Industries. The only place where they don't have a large global behemoth as a partner is oil and gas. So should be interesting. BEML and the DIPAM secretary's Twitter handle laid out this piece of news yesterday that multiple expressions of interest have been received for privatization of BEML, and now this will move on to the second stage. But the point being that there are so many people who are interested in BEML should mean that the divestment should not be a difficult task. Whatever time it takes, but it shall not be a difficult task. And maybe, just maybe, the markets will like the sound of this. So if BEML reacts today, you know why it is reacting. Edelweiss could be interesting. They've announced a strategic investment in the wealth management business from PAG. It's an earlier investor. They've now made a primary and secondary investment of 2,366 crores and now will hold a controlling stake in the wealth management business. So this should be positively viewed, I would reckon. Watch out for this brand. And BPCL, I think yesterday, so many people floated the news or the expectations from the government. I think it was an Indian Express report which said that the government expects some 70,000, 80,000 crores, which translate into 750 to 700 rupees per share. Now, JP Morgan comes out with the rating, with the report, their overweight rating and a target price of 550. So they are saying, and let's stick to this for a bit. They are saying that 700 to 750 per share is not impossible, but it would depend on who's bidding or who's joined the consortium, which means that is JP Morgan saying that there could be more than the three bidders who have been shortlisted who could join the consortium? Let's wait and watch. The second part is that they are saying that aside of what's happening to the divestment process, if indeed the normalized earnings and the normalized GRMs reach about $5 per barrel benchmark, then, and if the crude prices stay around these levels, which allow BPCL to benefit from the Kochi upgrade, then on a normalized basis, their FY23 EPS at 48 rupees per share implies a fair value of 690 rupees per share. So viewers, the important part is what JP Morgan is saying is that fundamentally, irrespective of what happens to the bidding, if indeed the other things stay constant, then BPCL by itself will show an EPS of 48 rupees, and therefore the implied fair value could be 690. They are not baking in all the positives, and therefore maybe their target price is 550. And I would guess their target price is 550 for FY22. For FY23, it might go up as well. But that's the beauty. that this is all of these assumptions are minus divestment. With divestment into play, the numbers could just look slightly different. So there are a few interesting things at play. It's the expiry week. Maybe VIX inches up slightly, but that shouldn't be viewed negatively. I would, like I said yesterday, I think that the stage is set for a positive construct for the equity markets, for selective long positions to be built. So maybe don't be completely risk averse. The next 2-3 days have a chance of a tactical pullback and tactical long positions, and therefore tactical gains to be made. But selectively, watch out for some of the beaten down pockets. Watch out for BPCL. Watch out for Maruti in the session today. Watch out for commodity plays and IT too. And more importantly, please stay safe. And if you are in public, please wear your masks. It's not gone as yet. We are almost in a second wave, if not already in it. So please stay careful for yourself and for your loved ones. Thanks so much for tuning into the Trade Setup.